If you don't think bonds should be in your portfolio, what if I could teach you how to receive double the dividend yield on half the risk of stocks? What if, in addition to stocks and real estate, you added a bond ETF to your portfolio? You might have outperformed the market this year while experiencing less volatility. That is the potential of bonds. They won't make you rich, but they will secure your money and give income when stocks crash. Even with increased interest rates this year, a bond fund has offered a dividend yield that is more than double that of stocks. In this video, I'll discuss the 5 top bond funds to follow right now, as well as the one that every investor should buy. We'll cover all of the techniques here, from value to growth, tech companies, and real estate. And by the conclusion of this video, you'll get a portfolio of the top stocks to buy. Let's start with a couple of the bond ETFs I'm keeping an eye on before I teach you what to look for in these and how to choose which is ideal for your portfolio and how much you should invest. First bond fund in our list is the SPDR Portfolio High Yield Bond ETF, ticker SPHY, which is one of the riskier products on the list but has a terrific yield of 5.64%. The fund invests in over 2,000 unique bonds, all of which are in the non-investment grade credit category, which delivers the highest yields in this market. You have a number of consumer firms, telecoms, and energy names, but no bond funds for more than a third of your portfolio. A short recap of bonds and why they are so much better than stocks. Bonds are a loan to the company. They pay out interest twice every year and then return the loan amount at the end of the bond's life. This means that companies are legally required to pay back their bonds plus interest, whereas stockholders only get a return and dividends as long as the company can generate profits and stay in the market, whereas bondholders have a higher rights to the investments. The yield on bonds is largely dictated by a company's credit rating, which is a measure of how financially stable the company's finances are and how likely it is to repay the said debt. A higher risk equates to a lower bond grade and a higher interest rate. Return to the high-yield bond ETF, and given that these are less highly rated businesses and those credit ratings, bond values will fluctuate more with the stock market and the overall economy. It's only that if the economy suffers, more of these bonds are more likely to default. Thus, this one fluctuates a little more compared to some of the other bond funds. Having said that, the volatility remains less than half of the stock market, with a standard deviation of around 21% for stocks and only 8.8% for SPHY funds. I won't dive into the arithmetic behind the standard deviation since it's only relevant to some analysts, but think of it as how much an investment moves about when markets drop. For example, the S&P 500 has a 20% probability to rise or fall in every given year, which is excellent, while stocks are soaring but not as good as when they drop. In fact, the high-yield bond ETF only rises or falls approximately 9% on average, is far less volatile, and can offer a dividend yield nearly 4 times that of equities. It's an investment you just cannot ignore. The low volatility can also be seen in the price chart, since the SPHY and the larger stock market have delivered roughly the same returns this year as the bond fund, but with a considerably smoother ride. You don't have to monitor your portfolio plummet and wonder whether you'd still be able to meet your objectives. Thus, the high-yield bond ETF is likely to be better for investors who can tolerate a little more risk yet desire the safety of bonds as part of their portfolio. You'll get a bigger income and protection from a crash. I understand bonds haven't lived up to the safety that they're meant to give this year, and a lot of investors are still concerned with rising interest rates. The iShare Core Aggregate Bond Fund ticker AGG has dropped 10% in 6 months, which is unprecedented in fixed income. In reality, it had the worst first-half performance since 1788. Although if you look at the chart, bonds still secured your portfolio. Not only did bond funds suffer half the losses compared to stocks, but it was a lot smoother ride rather than a fall lower. And the 5 bond funds I'll mention today outperformed even that, providing more than double the dividend yield at half the risk of stocks. Let me know in the comments if you have any other questions about investing. Let's return to the video. Now let's return to our list and I'll demonstrate to you what to look for in these and how much you should invest in bonds in a moment. The VanEck Fallen Angel High Yield Bond ETF, ticker ANGL, is another with a bit greater risk but a strong 4.3% dividend and significant potential upside. The fund presently invests in bonds that were issued with an investment grade rating or a solid financial rating, but were lowered to the high-yield category. Bonds are often downgraded when its financials weaken or when a firm imposes additional debt, but 93% of the bonds in this fund are in the first 2 risk classifications, which are just below investment grade, making them relatively secure investments. But what happens if these fallen angels are downgraded? The bond price falls, but they continue to pay the same yield. Thus, the interest rate rises. The default rate is low because they are all still stable companies, and this group of bonds has surpassed the broader high-yield index in 11 of the past 15 years. The expense ratio is under 1/3 of 1%, and these are weights of good-sized companies such as Sprint and Freeport-McMoRan. Almost 3/4 of the fund is invested in bonds issued by U.S. companies, with the remainder in developed countries. It is also well diversified across sectors, with bonds issued by companies in 9 industry sectors. Because of that non-investment grade rating, this fund is also the second riskiest of the ones we'll review today. The fund outperformed stocks in the first half of the year, but has recently begun to trail as stocks have made a recovery, albeit the dividend yield has accounted for the difference. The iShares TIPS Bond ETF, ticker TIP, is the next bond on our list, and it is by far the outstanding investment this year. TIPS stands for Treasury Inflation Protected Security, which is a bond issued by the United States Treasury with an interest rate and value that is inflation adjusted. Because of the inflation protection, they are one of the greatest investments this year, and the TIPS Bond ETF provides a magnificent 6.4% dividend return. But not everything, because they're issued by the U.S. Treasury, the payout on TIPS is guaranteed, and the interest is tax-free in most states. The bond fund does not have such guarantee, but because it only holds those particular bonds, its investments are always secure. With the widespread rise in interest rates, the TIPS fund has experienced the same losses as all bond funds, but as you can see, it truly saved your money through the worst of the stock market crisis. When the S&P 500 was down 20% from June, the TIPS fund dropped just 12% and still provided a 6% or higher dividend. In fact, the TIPS ETF has the lowest volatility in the category and has less than 1/3 of what you'd see in the stock market with its dividend, low volatility, and inflation protection. This might be the best bond fund in this video, but I prefer the last 2 bond funds. Of those last 2 bond funds, one has the highest return and the other has the perfect balance of both risk and return. But I'd like to help you figure out what to search for in these and exactly how much to invest. Bond funds are a simple and inexpensive way to invest, typically holding thousands of different bonds in a single fund. Investing directly in each bond is typically not cost-effective for investors, since you pay a fee on every bond and don't obtain the necessary diversity. The most important consideration, like with stock funds, is what sort of bonds you want and what amount of security you want. Bond funds are available for every sort of fixed income investment, from the secure government treasuries to higher yielding and riskier junk. Most investors prefer bonds. Going with a comprehensive bond market fund will provide you a little bit of everything while balancing risk, return, and yield. Now, how much money do you put into a bond fund? Actually, it depends on how much safety you require from a stock market fall. For example, someone with 5 years till retirement requires significantly greater portfolio security and predictable income flows than a 20-year-old investor. An older investor may put up to half of their money in bonds, whilst young investors may want at least 10% to 20%. I would always hold anything and bounce, not just to save myself from a crash, but also to take advantage of reduced pricing when stocks do drop. Next, the Global X Super Income Preferred ETF, ticker SPFF. A preferred share is a hybrid of stocks and bonds. It is not a financial obligation like a bond, but it does provide a set dividend payment that is larger than most stocks. Preferred shareholders receive their dividends before investors, making them less risky, and the majority of them convert to normal shares at a specific price. So preferred shares don't have the same upward potential as stocks, but they do offer greater returns and the security of bonds. Now, why I prefer this one is partially because of the safety, and also because you get a larger return than other bond funds. The Global X Fund invests in 50 of the top-paying preferred companies and generates a 6.4% dividend yield against a 0.6% expense ratio, which is very impressive for one of these specialist ETFs. The fund does bias somewhat towards financials and bank stocks, since those are the ones that offer the greatest preferred share payouts. There are a number of huge bank names here, such as Wells Fargo and JP Morgan, as well as some smaller firms such as Ally Financial, and that means this is likely to be the most volatile of the group, violating the rule of half the risk in comparison to the market. With such a standard deviation of about 17%, it is still less risky than stocks, yet not as risky as real bond funds. I did want to mention this one since it's a wonderful alternative for those who desire a balance of bonds and stocks. The bond-like feature of preferred shares has played a role this year, and not only has the fund surpassed the larger stock market index, but it hasn't plunged lower either, implying lower volatility. Finally, while this bond has the lowest dividend yield on our list, it has outperformed the market this year, securing your money with the Invesco Senior Loan ETF, symbol BKLN. The fund now owns more than 140 big institutional loans, the majority of which are non-investment grade, meaning they are riskier but provide higher returns. Because most loans are due within 5 years, they do not have the same interest rate risk as other bonds. So if rates increase, this bond fund will not suffer as much. Because they are short-term loans, the dividend yield is lower at 3.4%, but the volatility is also among the lowest, which helps to balance the risk from equities in your portfolio. With recession concerns and rising interest rates, loans have taken a blow, much like the high-yield bond fund we looked at. But with the economy eventually rebounding, this one could offer a large upside price return in addition to the dividend. Despite those rising rates and recession concerns, this one has outperformed the stock market by more than 6% in the first half, in addition to a dividend yield that is more than double the market average. Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching. Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.